Hi everyone, this is Paul here. Yeah, I will start off today with the Singapore Weekly and then just a quick update on our NetLink Trust. No coverage, but there was an analyst briefing, so I'll give you some details on that. Just on the Singapore Weekly update, no change in our STI target 3270. More interestingly has been the macro backdrop. We do see some pickup in the global indicators of our global economic activity. Uh, after 2 months of decline, we do see a pickup in the ISM new orders, the German IFO service, and even the Korean and Taiwan exports are kind of rebounding on the latest numbers. Likewise for semiconductor sales too. So this pans out to be quite a Goldilocks scenario for equities. We are experiencing a rebound in global growth. At the same time, we have low inflation. I think the recent numbers that came out on Friday, you can see that the CPI or even core CPI in the US has seen 5 consecutive months of decline. So we got this very bullish scenario for equities in general, where growth plus low inflation. No change in the stocks that or sectors we recommend. We are buying sustainable yield and property. We will, on company updates will be the IPO of NetLink Trust, which I will further elaborate on the following slide, and also the GLP takeover, which the note was released this morning. But I guess the key takeaway was that the price of this takeover was a 1.3 times price to book, and the property sector as a whole in general is trading around 0.8 times. I'll move on to the next slide. Just some details of the NetLink Trust IPO. It's listing on the 19th of July at around 3 p.m. The market cap is about 3.1 billion. When I looked at it compared to all the STI stocks, the smallest market cap on a STI stock is about 4 billion. So I'm not sure whether this can actually even qualify for the STI, but because of the large free float, that could be a consideration. The other point to note is, of course, the dividend yield. They're looking at 5.7%, which is for the year ended March 19. Some key highlights just to get some understanding of the company. It owns the fiber in Singapore. It is the sole provider of fiber to all the residential homes and to all buildings. But for buildings, of course, the other telcos actually do provide. So for commercial access, the other telcos are a competitor. We'll move on to the second point, which is revenue. Around 60% of it comes from residential. But if you include the co-location revenue, which is the co-location means the active equipment which the telcos need to install in some of these central offices, which is the CO here. Residential could be almost 60 to 70% of revenue. In terms of the customers, as you can see, Singtel is about 55 and StarHub and M1. So all the telcos are essentially their customers. So basically, whenever a residential household connects for fiber or opts for fiber in their home, they pay around $13.80 per month to NetLink Trust. More important is the assets. They've got 77. They have the fiber, of course, but more important again, it's the ducts. This is basically the pipeline, the pipes that carries all these fiber. That's the core asset that they have. And they are connected to 30,000 buildings, or essentially all the buildings in Singapore, and about 1.4 million residential homes. In terms of the positives, they are actually obviously a monopoly. They are the sole provider of residential fiber in Singapore. There's a high leverage. That means because of the heavy fixed costs, which already covered, so any dollar of revenue they generate, there's a huge EBITDA margin. The dividends are tax exempt, and they are growing around 7%. Do note that there are forecast numbers in the prospectus itself, so that kind of helps us in kind of ascertaining the outlook of this company. And when we look at the assumptions in the prospectus, it looks reasonable, somewhat conservative, because they are assuming about 90,000 or 80,000+ in subscribers for FY 18 and 19, whereas the last 2 years they've been generating 100 to almost 200,000 of new subscribers. But the items to take note of course, is this thing called the regulated asset base. Because this is a monopoly, so the authorities have to control, so they do get regulated returns. Basically the amount that they charge, like I mentioned earlier, the $13.80 per month. That is has to be, someone has to make sure that they don't charge too excessively. So this is every 5 years the authorities will actually check and have and give them some fixed return sort of, and this is assessed every 5 years. The last one was already done, so FY18 you're getting new pricing, so that this is not something to worry about, at least for the next 5 years. I did add figure 2, as you can see, the financial summary. To take note of is that the distribution that you're getting does depend on leverage. If you look at figure 2, the distribution 179.3, that's the amount of dividends that they're going to pay for you to enjoy that 5.7%. But as you can see, this is not supported by the free cash flow, which is about 98 million. So the free cash flow is only covering half of this payout. So the rest actually comes from leverage. And of course, the key is that for them to maintain the payout in FY20, they have to bring down the capex to a more normalized level, about 40 to 60%. Figure 1 is just some details of the issue, the market cap, and also the number of shares. That's it. I'll move on to Richard on Ascendas. Thank you.
Good morning, everyone. This is Richard speaking. So, last week we initiated coverage on Ascendas REIT. The title of the report is Growth Through Rebalancing, Stability Through Diversification. So, during this presentation, you repeatedly hear me emphasizing on these 2 points: growth through rebalancing, stability through diversification. Okay, so we initiated with accumulate rating, target price 286, last close was 260. Last close was 260 on Friday, and forecast dividend of 15.8 cents for this current FY. 52-week range has been 220 to 276, market cap 7.5 B. Before we go into the actual report, let's recap on what let's recap on the industrial sector at the moment for rents. So this is the excerpts from the last sector report that was published on 8th of May for first quarter 2017 JTC data. In summary, actually what is the view now is there's an improving outlook for industrial rent. First sign of occupancy stabilizing, that's over here in this chart showing the occupancy. Upcoming supply tapering in 2018. So you'll recall that 2016-2017 there was a larger than usual supply of industrial space, and that had put pressure on rents. But you can see from this chart here, 2018 the supply is tapering. So next thing is uptick in industrial activity. So you can see from late last year, PMI has been going up and industrial production has been improving as well. It's in positive territory at the moment. So now go on to the investment thesis, which is an established and diversified platform that continues delivering returns. So this is an established platform with a sponsor, Ascendas Bridge. The REIT has grown its DPU over the last 5 years at a CAGR of 3%, and we expect the DPU to be sustainable through prudent management of the portfolio and capital. Next point is stability through diversification. There are 131 properties in the portfolio as at the end of the last FY. The properties are diversified across property type, geography, lease structures, and tenant trade sectors. Overall, none of no single property accounts for more than 5.4% of gross revenue. And the REIT also is able to tap a diverse source of capital. Next is growth through rebalancing. So the Singapore portfolio is under continual rebalancing towards higher value-added manufacturing. What this means is that the portfolio is taking on more properties of the business park, science park, and high specs and data center type of properties, and rebalancing out away from the light industrial and flatter factory types of properties. Australia, they continue to expand their portfolio, and for China, they divested the portfolio of 3 properties in FY17. For investment merits, so REIT is the largest industrial REIT with an improving outlook for industrial rents. At the moment, oversupply of space is still a concern, but we see that supply is actually tapering in 2018 next year. Now there's an uptick in industrial activity, and we believe that rents to bottom by 2018. The sponsor also has a ready pipeline of industrial space, so Ascendas REIT does not give a ROFR to REIT, but nonetheless, REIT still has access to the pipeline of over 1 billion business and science park properties in Singapore. The Australian platform is also quite sizable and is tapping on favorable outlook for Australia. Positive GDP growth is expected for Australia, and robust leasing demand is expected in Sydney and Melbourne, of which 76% of the Australia portfolio is located. The REIT also has a relatively low gearing, and that will give it the headroom for inorganic growth. So at the moment, cost of debt is 3%, which is lower than the median 3.4 among peers. His aggregate leverage is 33.8%, and this gives it a headroom to grow the AUM by 20%. Lastly, is an attractive dividend yield of 6.1%. Investment risk is firstly protracted uncertainty in business sentiment. There's a cautious outlook from tenants. They are reluctant to expand space and renew their leases early. Tenants are cautious because they are uncertain of their own business prospects, and if this remains protracted, then that would result in a muted demand for space and pressure on rent. Second is a disorderly interest rate hikes. So what this means is if interest rates go up faster than expected, then this would negatively impact the income available for distribution. And for the Australia portfolio, it faces 2 key risks. First is the unfavorable changes to the withholding tax regime, and the portfolio is also concentrated in logistics facilities. All of the properties are logistics facilities except for one, which is a business park property. Okay, so a snapshot on REIT is the largest REIT in the S-REIT universe by market cap, and it was the first industrial REIT to be listed. It's backed by the sponsor, Ascendas REIT, and the sponsor is 5149, owned by Temasek Holdings and JTC. The sponsor has a 30-year track record in the industry and with a pipeline to over $1 billion of business and science park properties in Singapore. The manager, Ascendas Funds Management, is a wholly owned subsidiary of the sponsor, and the manager has a 3-pronged strategy of proactive portfolio management, disciplined value-adding investments, and prudent capital and risk management. Trustees HSBC. For the Singapore portion of the portfolio, there's 103 properties valued at 8.6 billion and has 3 million square meters of space. The properties are diversified across these 5 property types. For the Australia portfolio, there are 27 logistics facilities and 1 business park as at end of the FY17. The portfolio is valued at Sing dollar 1.3 billion and with 692 square meters of lettable area. Okay, so investment thesis, I've said at the beginning, the key point is stability through diversification, growth through rebalancing. So we'll go through each of them now. So we'll start with the first one, diversification by geography and property type. So Singapore remains the home base. China portfolio was divested in FY17. So now the current split between Singapore and Australia is 86-14. And for Singapore, the properties are the 5 types which I showed in one of the slides earlier. Majority of the leases for Singapore is a multi-tenanted property. Australia is attractive for its freehold land and market transparency. There are 28 logistics facilities and 1 business park property at the moment, and the majority of their leases are single tenant buildings. So how you look at this chart here, this small light green area represents the Australia portfolio, while the larger dark green ring here is the Singapore portfolio. So for Australia, you can see by valuation, mainly is this logistics properties, and this thin strip here is the business park. So that's the distribution of properties within Australia. And then this is for the Singapore segment. So this is showing Australia here. The light green sector is for multi-tenant buildings, while the dark green is for single tenant. And these are the 5 different property types located in Singapore. So you can see from here, Australia mainly is single tenant buildings, while Singapore mainly is multi-tenant buildings. Next is diversification by number of properties. So there were 131 properties in the portfolio. Largest contributor to gross rental was only 5.4%. This came from that property Aperia. It's located at Lavender Street and is a mixed-use property with 2 office towers and connected to a retail mall. So the top 5 properties contribute less than 20% of portfolio gross revenue. So this shows the diversification through the numbers of properties they have. Next is a tenant trade sector and individual tenants. So this chart here shows the distribution of their tenants trade sector. So the tenants are diversified across more than 20 trade sectors, and third-party logistics and freight forwarding is the largest, which accounts for 10.6% of gross revenue. This shows the top 10 tenants for the portfolio. In total, they have more than 1,000 tenants, and these top 10 tenants account for 20.8% of the gross revenue. Their largest tenant is Singtel here, and it contributes 4.8% of their gross revenue. So what this shows is that there's a low single customer concentration risk for a REIT. Now we move on to the part about growth through rebalancing. So the first thing we'll go through is a Singapore portfolio. So Singapore portfolio, they are rebalancing it to increase their exposure to business and science park properties and high specs properties as well. So 4th quarter 2017, they completed the acquisition of 12, 14, and 16 Science Park Drive, which is leased out to DNV and DSO. One property is to DNV and two buildings are to DSO. So with this, their weightage to this science park, business park, and high specs properties is now 65% by valuation in the Singapore portfolio. So that's more than half the portfolio. They also have some ongoing redevelopment and AEI projects. And lastly, they are recycling capital through divestments as well. So last year they divested 4 Acres Singapore, which was a build-to-suit to Unilever, And just last week they divested this Penwoodlands Link, which is a light industrial slash warehouse type of property. Next is we'll go into their investment in the Australia portfolio. So in 2015, they made a big acquisition. They acquired 26 logistics properties at one go for 1.1 billion Australian dollars. So these properties were spread across 4 different locations: Sydney, Brisbane, Melbourne, and Perth. So as I mentioned just now, Sydney and Melbourne, they are having the most positive outlook for robust leasing, and you can see Sydney, this, and Melbourne here. So they are taking up about 70% of the portfolio in Australia. Since this first acquisition of the 26 properties, the portfolio has grown to 1.26 billion Australian dollars with the addition of 2 logistics facilities and a business park property. So to compare Australia and Singapore, you can see the yields are comparable, but Australia is on freehold land. This different from Singapore, where the land lease is now getting shorter, maybe 25 to 30 years. So Australia, the cap rates are weighted average cap rate is 6.42%, and properties are on freehold land, whereas in Singapore, cap rate is at 6.27, and it's a 46.5 years weighted average land lease expiry. What this bullet point here is just mentioning is about acquisition done after FY17, which was in March 2017. So they acquired 1 logistics property in the first quarter of this year. This table is just a summary of the timeline of their building up of the Australia portfolio. Last point is a China platform. So in FY17, they divested the 3 properties in China. So there'll be some negative impact in terms of revenue contribution. Nonetheless, they still took profit at a good price and realized the investment gains on these 3 properties. They were divested at cap rates of 5%, and they realized gains of almost 200 million over the original cost. So our target price is $2.86. Sources of growth in FY18. So inorganic growth will come from the recent acquisitions, which is the 2 Australian properties that were completed in second quarter last year and first quarter of this current FY, and 1 business park property in Singapore, which was completed in fourth quarter of the last FY. This will be offset by the divestment in the China portfolio, which will not be contributing any revenue this year anymore. Organic growth-wise, expected to be muted as the Singapore portfolio is currently facing an oversupply situation. Singapore portfolio still accounts for about 87% of the total portfolio by valuation. And there will be some adverse impact on DPU due to conversion of the ECS. ECS is the exchangeable collateralized securities, which was a form of exchangeable debt. So what happens is that during FY17, all these ECS were converted into equity, and that increased the number of issued units by about 10% during the year. This table shows the peers. So as usual, the larger capitalized REITs normally trade at a higher premium compared to the rest. So Ascendas is currently at 1.26 times book. Peer average is 1.1. It's also trading at a lower yield compared to the average. And why NA here? This is because Frasers Logistics does not have a 12-month track record yet. This chart shows the price to book for a REIT. It had only traded below NAV once, and that was after the global financial crisis. That's near the end of 2008 and the beginning of 2009 over here. And since then, it has never traded below book. The lowest it has went is 1.08 times book. Okay, this is just some of the appendix and background information for the REIT. This shows their trust structure, capital management here. So I mentioned about their diverse sources of capital. So for debt, they have 4 types, which is revolving credit facilities, committed revolving credit facilities, term loans, and MTN. So the average debt maturity profile is 3.3 years. And they have a strategy of having no more than 20% of debt maturing in any given financial year. But this 2018 will be a bit exception. This is just slightly more than 20, is about 21% here for this bar here. So they have a manageable gearing. I've mentioned this near the beginning. Gearing is low. They have a 2.1 billion headroom and potential to grow AUM by 20%. For interest rate exposure, they are already 79% hedged for a weighted term of 3.2 years. In terms of diverse sources of funds, so exchangeable collateralized securities, this was fully converted in FY17. They currently have a 3 million tranche of perpetual securities that pays a 4.75% coupon semi-annually. For equity, they have consideration units. What this is that when they acquired some properties from the sponsor, they will make partial payment through new consideration units. So such as the acquisition done for one at Changi City, which is a business park property at Changi Business Park, and the other one is the 12, 14, 16 Science Park Drive Business Park property at Science Park 1. Placement units, they also placed out units last year in order to acquire some of the Australia assets. And something new is the unit buyback mandate. So in the recent AGM, they had got a unit buyback mandate from unit holders. For their income from Australia, the currency has already been swapped and it's hedged on a 12-month rolling basis. Next is occupancy. So here the blue line shows the Singapore occupancy. It's high 80s, which is consistent with JTC sector-wide. And Australia is higher than Singapore, but that's because most of the Australian properties are single tenanted, so that's 100% occupied. This shows the expiry profile for Singapore portfolio. The WALE is 4.2 years, and you can see that most of it is multi-tenanted buildings. Conversely, for Australia, most of it is single-tenant buildings. So recap, REIT is an established and diversified platform that continues delivering returns. Our 2 key points are stability through diversification, growth through rebalancing. Our recommendation is accumulate, target price 286, last close price was 260, forecasted DPU of 15.8 cents. Next, we'll move on to Soilbuild Business Space. Soilbuild announced their results last week. We are neutral on it. Target price 73 cents. Forecasted DPU of 5.66 cents. That will give you a 7.6% yield over the last close price of 74 cents. Notably, revenue was up 10% year on year. This was due to the contribution from their acquisition of Bukit Batok Connection, completed 3rd quarter last year. Palace Marine also higher revenue from that because they completed an annex block on that property for the tenant. DPU was down 6 6.3% year-on-year. This was the effect of the larger unit base from the 1 for 10 pref offering they did in the third quarter last year. This was to acquire the Bukit Batok Connection property. Some positives for the portfolio. Quarter-on-quarter improvement in occupancy from 91.8 to 92.6%. This was from Atrium, which is their business park property at Changi Business Park. Is back to full occupancy this quarter from last quarter 97.9, and 72 Loyang Way also now higher at 22.8. Last quarter it was 9.9% occupied. So Thales Marine. So if you had followed the results for ESR REIT last week, they announced that their tenant Thales Marine had defaulted at their property 21B Senoko Way, and Thales Marine has consolidated their operations to the Soilbuild REIT property at 39 Senoko Way. That's the one with the new annex block that was completed in November last year. Negative and key challenge for the REIT now is 72 Loyang Way that remains underutilized following the default of their tenant there, Techniques Offshore. So the security deposit has been depleted and they are converting the property to multi-tenanted. So for this property, there's a special JTC requirement where they have to lease it out to oil and gas tenant. However, they've got a waiver from JTC that for 30% of the property, it can be a tenant from outside of the oil and gas sector. However, the remaining 70 must still comply with anchor tenant rule from the oil and gas sector. So this is one of the key challenges, to find a tenant from oil and gas who take up 70% of this property. Okay, we come to the end. We'll pause for questions now.
Yeah, hi, this is Paul here. We have a question on NetLink Trust. Is the valuation on the high side? Does the institution also think valuation is high during the book buildings exercise? Yeah, the pricing of 81 is at the lower end of the range. I think I know everyone's asking whether can you stack this thing. I think with a 2 billion of free float, I think it's going to be could be a bit tough to stack this stock. With a 5% dividend yield sticker headline, apart from clients that want really stable yields or can even leverage up to take up the IPO, the opportunity cost or missing is pretty low actually. So I think stacking it will be a bit of a challenge because the float is quite huge for this, and the last few IPOs hasn't really done particularly well.
Hi, this is Richard speaking. So there's a question. Question is, do we also see the same first signs of rental stabilizing for Cash Logistics Trust as what we are seeing for Ascendas REIT. Okay, I'll go back to the slide. Just to clarify, this is showing the sector-wide occupancy. So you still need to go and drill down into the specific property types. So for Cash Logistics Trust, the properties are exclusively warehouses, and warehouse space is actually one of the hardest hit this year because of the overwhelming supply for warehouse. The other thing to note is that about 5% of the leases in cash portfolio are expiring this FY. Okay, there's another question on REIT regarding unfavorable withholding tax for REIT's properties. Okay, so you have to pay tax on the income in Australia. So unfavorable changes, meaning if the tax rate changes, becomes higher, then that will affect your income from the Australia properties. This Richard again, there's a follow-up question on the Australia tax thing. As I said, you have to pay tax on the income in Australia. So if there is an unfavorable change, i.e. they increase the tax rate in Australia, then that would negatively impact the distributions. There's a question again on REIT. The question is from technical analysis point, is it a good time to buy REIT? And how about the increase in interest rate as feared by most at the beginning of this year? Is this rising interest rate consideration? Our target price is based on fundamental, not on technical analysis, and our target price has a 1-year horizon. For the second question, interest rate increase will be present. That's why if you look here, interest rate exposure has already been hedged, 79% hedged already for weighted term of 3.2 years. So it is a consideration, but there is hedging involved already.
Yeah, hi. There is a question on what are the chances of NetLink Trust to raise their forecasted DPU. I think there is a possibility, because like mentioned earlier, the in the inside the prospectus, there is a forecast, but there's a forecast, and also the assumptions in there is quite conservative. I think they could, just a guesstimate, they could actually raise this by maybe another 5% or 5 to 7% kind of upside to their DPU forecast. Again, this is just a guesstimate, because like I mentioned earlier, their assumptions underlying the residential subscription is pretty conservative at about 88 or 90,000. Historically, this has been almost 200,000. So there is upside to these numbers, and obviously when you're doing a forecast in such a big in the prospectus, you obviously prefer to put your numbers more conservative rather than make it aggressive, and people might claim that you might be misleading investors in such a high profile IPO. Yeah, thanks.
There's another question on REIT. Do you think REIT has still room to go beyond its 52-week high? 52-week high was 172, if I'm not mistaken. Our target price is 286, which is a 12-month horizon. Okay, since there are no more questions, we'll end the webinar here. Thanks for tuning in, and see you again next week.